Well, greetings, SBI students. My name is Jim Borden. I'm one of the accounting instructors for SBI for during this summer. So welcome to SBI. Hopefully you've enjoyed your coursework so far. So what we're going to take a look at today, it says at the top of the slide, the mechanics of financial accounting, the nitty-gritty of what we call the accounting process or the accounting cycle. So as you can see down here on this slide, when we talk about the accounting cycle, there are 8 steps that make up the accounting cycle. What we're going to go through in this video are really the first 4 steps of that process. Then the next thing you'll be taking a look at is sort of going through this again to reinforce it, and then going through steps 5 through 8 to really complete the accounting cycle. Once you do the cycle for one period, it keeps repeating itself. So whether it's monthly, quarterly, annually, companies go through this accounting cycle. At the heart of the accounting cycle, as you see, step 1 is understanding what we call a business transaction. This is some event that affects the financial condition of a company where items of value are exchanged. So for example, a company borrows $1,000 from the bank. The question is, what is exchanged here? Well, the exchange is the company's getting $1,000 in exchange for a note payable being issued by the bank. So $1,000 cash is coming to the company. In exchange, they now owe the bank $1,000. So at the heart, again, of this accounting cycle is really having a clear understanding of what is happening with these various business transactions. Accountants really have to understand and not simply do the mechanical record keeping associated with these transactions. Again, you really need to understand transactions, and it's a key focus of this class. You really can't report accurate financial information unless you truly understand the various activities that a company engages in. So as a result, accountants very quickly become good business people. They understand the nature of the transactions that the business is entering into. As one example of this, for several years, Businessweek magazine came out with an annual issue that ranked the best places to start your career. For the 3 years that this survey was done, the first 2 years, 4 of the top 5 slots were the big 4 public accounting firms. The final year they ran this survey, all 4 top spots were held by the big 4 public accounting firms. So this is an unbiased resource indicating that, again, if you want to start your career off in a great manner, the public accounting firms are a great place to do that. And the reason being, you quickly are exposed to a variety of ways of doing business. You're talking with high-level executives, CEOs, CFOs, and again, you'd be hard-pressed to find better ways to start your career. In addition, if you look at this surprise finding on innovation, CPAs, again, interact with a wide range of clients, industries, and business models. The result is you get to recognize what works, what doesn't, that perhaps, and find solutions perhaps your peers have missed. All right, so let's get started taking a look through this accounting cycle. All right, so some terminology here. The idea of journalizing. What we mean by journalizing is recording the data from a transaction. If you were to go back, 60 years ago, a lot of journal entries were done paper and pencil. Today, the vast majority, if not all of them, are done through computer systems. So that's journalizing, simply recording data from a transaction. Next, we have the notion of an account. An account is a place where we record increases and decreases in a specific balance sheet or income statement account. So for example, cash would be an account. We'd start thinking, what are some other examples of accounts? We could have, again, cash is an account. We could have inventory is an account. Okay. Note payable that we mentioned before would be an example of an account. So each account, if you want to think of it, if we had some sort of paper-driven system, each account would be on its own page. Okay? We then use this strange language at first of debits and credits to record our entries into these accounts. whether the account is increased or decreased. So when you hear the word debits and credits, maybe at first it sounds confusing, but they're very, very simple. All we mean by debit is we make the transaction, we record the transaction on the left side of an account, and credit simply means we record a journal entry on the right side of an account. Okay, so that's all it means. Debit means left side of an account, credit means right side of an account. And if we come down here in terms of, all right, so what do I do? All right, so yes, if you recall, we got these various accounts, assets, liabilities, shareholders' equity. It's going to be helpful to remember your accounting equation. If we just simplify it like this, assets equals liabilities plus equity. And we think about, with this equation, assets are on the left side of that equation, and liabilities and equity are on the right side of the equation. Okay, so we think about that, and these accounts that we're setting up, we often refer to these, as we can see up here, as a T account. It's in the shape of a letter T, as we see here. The way we can visualize what these accounts look like and how they behave. So when we think about assets being on the left side of this equation, liabilities and equity on the right side of the equation, that's going to help us in terms of how to record entries through this system of debits and credits. So again, debits are on the left side. So think about assets on the left side. That's what we call, that's where the normal balance of an account is, based on what side it's on the equation. All that means, assets on the left side, that's what we mean by its normal balance, or what it says down here. The ending balance of an asset account is a debit, whereas liabilities and equity, since they're on the right side of an account, their ending balance is a credit, which means its normal balance is on the right side of an account. Knowing that the normal balance of an asset is a debit balance, the normal balance of a liability or equity account is a credit balance, that's going to tell us how we increase the account. We increase an account on its normal side. So again, going back to our accounting equation, assets on the left side, that means the normal balance is a left side or debit balance. So to record an increase in an asset, we debit the account. That's really the only one you have to remember, okay? If you can just remember that to increase an asset, we debit the account. Everything else flows from that. So again, let me repeat that. If you can just remember and perhaps initially memorize that, to increase an asset, just make it a mantra. To increase an asset, I debit the asset account. Then everything flows from that. So to increase an asset, if you debit it, you would do the exact opposite to decrease it. The exact opposite of a debit is a credit. So that's why we say to decrease an asset, we credit the account. All right? So that's the left side of the equation, which are assets. Let's move over to the right side of the equation. Again, liabilities and equities on the right side of the equation, that means their normal balance is a credit balance, which means to increase a liability or equity account, we increase it. But again, let's just think about that. Coming back over here, if you hopefully have it now memorized, to increase an asset, we debit it. Well, liabilities and equity on the other side, the opposite side, if you want to speak of the accounting equation. So if you increase assets through a debit, you would do the exact opposite to increase a liability or equity. You would credit it, okay? So again, left side of the equation, assets, you increase it here. But if we go over here, other side of the equation, to increase liabilities or equity, those are handled with a credit, okay? So again, let me just summarize all that. It's a lot, but it's, again, the sooner you understand how debits and credits work, it's going to make things so much easier the rest of the course. All right, so quick summary. If you need to increase an asset account, you debit the account. To decrease an asset, you do the exact opposite, which is to credit the account. Switch over to the other side of the accounting equation. We're dealing now with liabilities and equities. Since they're on the other side of the equation, we do the exact opposite that we did with assets, which means to increase a liability or equity account, we credit those accounts. To decrease a liability or equity account, we decrease them. Okay? So let's start looking at some examples here. All right, so this first example we saw in the previous slide, the company is going to borrow $1,000 from a bank. let's record the journal entry. Okay. Many times I always tell my students, when cash is involved, think about what's going on with cash. So here we're getting $1,000 cash. The cash account for the business has gone up $1,000. That's an increase in an asset. So we go back here, cash is an asset. How do we increase an asset account? We debit it. Okay. So there's the first line of the journal entry. When we're recording a journal entry, we always record the accounts that are going to be debited first. So cash is going to be debited. Then we come over here and there's the dollar amount. Think of sort of some columns over here, and we're going to sort of have debit and credit columns for the dollar amounts. So there's that. The question is, every time we record a journal entry, we need to have equal debits and credits. So right now we have a debit to cash of 1,000. That means we need to have an offsetting credit entry. In this case, we're borrowing $1,000 from a bank. That creates a liability with the bank. We're going to call this liability a note payable. Okay, so there's the complete journal entry. Let's talk about a couple things with this. One thing to note here, notice that when we recorded the account that we're going to credit, we have an indent here. This was not lined up exactly under the name of the account that we debited. We have an indent here. And again, in a testing situation, doing your homework, always make sure it's pretty clear that you're indenting. Don't make your indent for the account you're crediting, so minute that it makes it difficult to understand that you're crediting the account. So make it pretty clear that this is an account you're crediting. The same thing with the dollar amounts. Notice these were not written underneath each other. Again, if we think about a left side and right side of these two dollar amounts, the dollar amount this is sort of the debit column. Here we see the credit column to go with the note payable. Okay, so there's your first journal entry. And the way you would say this, you simply say debit cash, $1,000, credit notes payable, $1,000. That's your journal entry. So congratulations. You've seen your first journal entry. Okay. As we'll see, once we are finished recording journal entries, the next thing we do is then what we say post our entries to their accounts. So going back here up top here we saw an account. Okay. Now we see specific accounts, a cash account, a note payable account. BB stands for the beginning balance. Let's say this is a brand new business. So the accounts are starting with a zero balance. And then in here, we simply transfer from the journal entry to these accounts. So again, from the journal entry, we had this debit to cash of $1,000. That's what's going on here, okay? So we're posting from the journal entry to the account, okay? The note payable was a credit entry. We'll see that down here, that we would credit the note payable account, okay? And again, down here, note that all debit balances when we record journal entries must equal the total of all credit balances. And then when we get to the end of the period, total debits should equal total liabilities. I mean, it must equal. Sometimes when you're first learning accounting, sometimes that doesn't work out. But yes, at the end of the period, total debits must equal total credits. This little clip art here, that's Luca Pacioli. He was an Italian monk from the 1400s that is credited with creating what we call the double entry system of bookkeeping. So again, over 500 years ago, 600 years ago, the system that we're still using today. It was a brilliant system. And it essentially has built-in checks. The fact that debits and credits need to equal each other, it's a great way of keeping things in check. All right, so let's move on. Start looking in more detail now at this process. All right, so the example we're going to look at is this Wildcat Auto. So Wildcat Auto was formed as a car dealership on January 2nd. Okay, so what Wildcat is going to be in the business of, they're going to buy cars from whatever source they get them, and then they're going to try and sell them to you and I, to consumers. All right, so let's go through a series of transactions here. So the first one, January 2nd, Bill Jackson, the sole owner of this business, contributed $200,000 cash to Wildcat Auto in exchange for 10,000 shares. Okay, so again, what is the exchange here? The business is getting cash in exchange for issuing shares of common stock. So right now, Bill Jackson owns all the shares of this business. So let's think about the journal entry. As I said before, to me, if cash is involved, that's always the easiest one to think about. So now Bill Jackson, the person, is a separate entity from Wildcat Auto. Wildcat Auto is the one getting $200,000 cash. So what's happening in cash? Cash is going up $200,000. How do we record an increase in cash? We do that with a debit entry. So we would debit cash $200,000. Okay. Then we need to credit something, right, to keep this in balance. In this case, what we're crediting is the equity account. Okay. This can go by different names. In this case, we're going to call it the common stock account. Right. So the way we would read this journal entry or say it, we say debit cash, $200,000, credit common stock. So the question is, what are these accounts? Cash, again, is an asset. Common stock is part of stockholders or shareholders' equity. Okay. So down here we see what is the effect of this transaction on the accounting equation. So again, down here we got the accounting equation. Assets equals liabilities plus shareholders' equity. Let's just see what happens when we record this in this format, almost like an Excel spreadsheet format. Okay. So cash, $200, and the common stock account went up $200,000. Right. Then this idea of book value, and previous slides you saw the notion of book value. A couple ways we can define book value. One way is book value is equal to assets minus liabilities, or book value is simply total shareholders' equity. Right. So in this case, total assets are 200, liabilities are 0. So 200 minus 0 would give us $200. Or the other way, just look at shareholders' equity. Right now we have $200 in shareholders' equity. Right. So, or in thousands, $200,000. That is the book value of the firm. Okay. Let's move on. Let's see what the next transaction is. All right. So the first thing that Wildcat Auto did was to buy a building. It's going to act as both a retail and office site. He purchased the building for $120,000 cash. So again, as I said before, when you're thinking about how to record this, if cash is involved, think about what's going on. Is cash going up or is cash going down? So we're buying this building for $120,000 cash. We're using up $120,000 cash. So cash is going down. So let's think about cash as an asset. How do we record a decrease in cash? Again, we record decreases in cash with a credit entry. So now one part of this entry is we're going to be crediting cash for $120,000. But let's not write it yet. We said before that we always record our debits first. You need to think, what account are we going to debit here? Well, again, what did we just do? We bought a building. Okay. What is a building? Building is an example of an asset. So the company just bought an asset. So we have this building account that initially we didn't own a building, now we do. So the value of that account just went up $120,000. How do we record an increase in an asset account? We debit the account. So we debit buildings $120,000 and we credit cash $120,000. All right, let's come down and just look at what is the effect of this transaction in the accounting equation. Let's come down here and see what's going on. So we see that, again, when an account goes down, you can either write, a negative 120. You can put parentheses around the number to represent that this is a decrease in the account. This example, we're putting parentheses around the number to indicate that we've reduced the cash account. Yet, at the same time, we increased an asset account. So this is what we call an asset exchange. One asset account went up, in this case buildings. One asset account went down, in this case cash. So the question here, what was the impact of this transaction on the book value of the firm? Again, two ways to answer this. The easiest way by looking at this, one way to define book value is what is the value of shareholders' equity? Well, nothing happened with shareholders' equity. It's still $200,000. Okay. The other way to define it, what happened to your total assets? Well, one asset went down, one went up by the same amount. So no total change in total assets, no change in liabilities. So no change in the book value of the firm. So no effect. So asset exchanges have no impact on the book value of the firm. Okay? So we're moving along here. We've got 2 journal entries under our belt here. Let's see what the third transaction is. All right. So January 3rd, Wildcat went out and bought 4 automobiles for $20,000 each, $80,000 total, and they bought them on account. So first off, what does that mean? So buying on account means you did not pay cash yet, that you owe whatever company or individual you bought these cars from, you owe them $80,000. Okay. So in this case, what was exchanged in this transaction? Wildcat is getting 4 cars in exchange for an IOU, basically, that they owe a business. Here's an IOU. We'll give you an IOU. You give us the 4 cars. All right. So again, let's think about the journal entry here. As always, easy part is cash. Unfortunately, cash was not part of this journal entry. So you need to think, what is going on here? Did we get any assets? Well, yeah, these cars are going to be our assets. Okay. This is, again, we have to think about what this business is. Wildcat is in the business of buying and selling cars. Just like Walmart is in the business of buying products from their suppliers and selling them to us. At Walmart, those things that they're buying from their suppliers and then they put out on their shelves and we go to their stores and buy it, that has a specific name. That is known as inventory. So inventory represents goods held by a firm that they're trying to sell. In this example here of Wildcat Auto, that's what those cars are. That's inventory. Inventory is an asset. It's an item of value owned by the business. That just increased. How do we record increases in an asset account? We're going to debit inventory. And the question is, what are we going to credit? Similar to what we saw before, we're going to credit a liability. Since we now owe somebody, we're going to credit, and the account name that we refer to this as is accounts payable. All right. So the way we read this, we debit inventory, credit accounts payable. Okay. It might be worth briefly talking about the difference between a notes payable and accounts payable. They're the 2 liabilities that we've seen so far. Notes payable, we're going to basically reserve for when we borrow money from a bank. That creates a note payable. An account payable, on the other hand, is when we owe money to a vendor. And in this course, those vendors will be our suppliers that we're buying our inventory from. Okay. So when we owe our vendor, when we buy something from them and we don't pay cash, it creates this liability that we refer to as an accounts payable. And again, recall accounts payable, that's on the right side of the accounting equation. It's part of liabilities. How do we increase a liability account? We increase something on the right-hand side of the equation by credit entries. Okay. What's the effect of this on the accounting equation? Let's come down here. Okay. So we are increasing an inventory account by 80. We are also increasing a liability account by 80,000. Again, that's what that credit does. So there's the effect on the accounting equation. Let's move on to our next one. All right, January 7th. Wildcat paid $60,000 cash towards those cars that they bought in the previous transaction. So they're essentially paying for 3 of the 4 cars. They'll pay for the 4th one at a later date. So, here we see cash involved. So let's think about what happened to cash. Did it go up or down? So Wildcat is paying cash. So cash is going down. How do you record decreases in cash? With credit entries. Again, cash is an asset account. Assets are on the left side of the account equation. How do you decrease an asset account? You decrease it with credit entries. So when we record this, we're going to, again, credit cash, but we record credits after we record the debits. So now we think about, all right, so what are we going to debit? So if we think about this from the prior transaction, we had created this account, it's payable. We owe $80,000. Now we're reducing how much we owe, right? Because we're paying them off. We're paying towards that liability. So we're effectively reducing that liability with our suppliers. So how do you reduce a liability? Again, liabilities on the right side of the accounting equation. How do you reduce something on that side? You debit a liability to reduce it. So let's see this journal entry. We're going to see that we're going to debit accounts payable 60,000 and credit cash 60,000. Okay? Again, the effects of those, both of those reduce those respective accounts. A debit to accounts payable reduces that amount. A credit to cash reduces that balance. Again, the effect on the accounting equation. Let's just take a look at this. And so again, we see the parentheses around the $60,000 cash, and then we see a parentheses around the $60,000 in accounts payable. Okay. One thing I should point out here, as we're recording these transactions, there's no need to keep calculating what is the new balance in the account. So for example, we started with 0 in cash, then we increased it by 200, we reduced it by 120. There was no need to say, well, right after that, there's 80,000 in here. You do not need to do that. Okay, you'll wait till the end of the period to figure out what is my ending balance in that account. Okay, all right, so let's move on. And again, let's see what's going on in here. So we're done with our transactions. Let's go to this step, and we see it all completed for us. The idea of posting those journal entries to the specific accounts. So here's the accounts we've dealt with so far. We've seen cash, inventory, accounts payable, buildings, and common stock. Okay, those are the accounts that Wildcat Auto has dealt with so far. Okay, and what these numbers refer to, the one, that was journal entry number 1. So if you recall journal entry number 1, and you should be able to look at these set of accounts and sort of in your mind recreate what happened. So here we see a debit to cash of 200,000 and a credit to common stock of 200,000. You should be able to state with confidence that it looks like transaction number 1 was that the company raised $200,000 cash by issuing common stock. If we look at journal entry number 2, let's see where our number 2 is. We see a 2 here and a 2 here. And what happened there? Well, it looks like we see a debit of $120,000 under buildings. Debits increase our assets. So he must have bought a building. And the question, how did we pay for it? It looks like, again, we go to cash. We can see that we bought a building by paying cash. All right? So that's the beauty of looking at these accounts. Again, we call these T accounts because, again, they're in the shape of a T. So it's a great name, a T account. And again, remember, we've got asset accounts, and we've got our liabilities and shareholders' equity accounts. Again, asset accounts, the normal balance is a debit balance, and the normal balance for liabilities and equity accounts are credit balances. Notice now, if this was the end of all of our transactions, we could calculate what is known as the ending balance in the account. So to do that, you just add up all your debits and offset them with all your credits in the various accounts. So with cash, we see this $200,000 debit offset by $180,000 in credits, leaving us with a balance, an ending balance of $20,000 in cash, represented with a debit balance of $20,000. Okay. Inventory, simple one. All we did here was increase it by $80,000, so we end at $80,000. The only other one that sort of had offsetting transactions, accounts payable, started with an $80,000 credit here. Later on, there was a $60,000 debit to it, so that offsets it, and we end with a $20,000 credit balance. That's the normal balance. Everything is making sense here. All of our asset accounts have balances on the debit side, and all of our liability accounts and equity accounts have balances on the credit side. Okay, so everything's good. Next thing we can do, just to sort of make sure we're on the right step here, the right path to eventually prepare the financial statements. Before we get there, a very useful step is prepare what we call a trial balance. A very simple document. It's not one of the formal financial statements. It's not an income statement. It's not a balance sheet. It's not a statement of retained earnings. It's not a statement of cash flows. It's sort of a working document to get us ready for preparing those financial statements. So all we do with the trial balance, and notice here we have a little heading here, the name of the company, and the trial balance as of a certain date. Here's where these accounts stand right now. Okay, so all we simply do, we list the names of all the accounts in order by assets, liabilities, equity accounts. Then we have two columns over here, debit or credit, and we put what is the ending dollar amount in those accounts, again, as of January 7th. Right? So we have all that. We can go back to the previous slide and see all those. These are coming right from here. So this $20,000 cash, when we go to the trial balance, that's where that number is coming from. Okay. So again, the only purpose really of the trial balance is to make sure that our debits and credits equal each other. So again, if we did all of our journal entries correct, where every individual journal entry had equal debits and credits, then by definition, your trial balance has to balance. And again, note it does. Total debits of 220, total credits of 220. Right? So everything's good. So the question is, what if it doesn't work out? Sometimes when you're first learning accounting, it's a very common situation. Sometimes debits do not equal credits. And what does that mean? It means you've made a mistake. No need to panic. Sometimes simple mistakes. You wrote the number down wrong from the journal entry to the T account, or from the T account into your trial balance. You put something in the wrong column. Whatever the case may be, sometimes it's a simple mistake. Go back, double check your work, and hopefully by doing that, you find the mistake. Realize sometimes trial balances don't catch mistakes. For example, if you completely forgot to record a journal entry, but all your other journal entries were correct, your trial balance would still be in balance, but it would be wrong because you're missing a journal entry. Okay. I remember when early on, I was at Drexel getting a PhD in accounting, and I was a TA, and a job opportunity came along to be a bookkeeper for a local Philadelphia firm, a very small job. And figured, all right, I'm getting a PhD in accounting, I'm teaching accounting. Even though I'd never done accounting for a company, I thought, I think I can handle this. So I applied for the job, they gave me the job. And I still recall, after about a first week, I recorded all these transactions, and I went to prepare my first trial balance. And I still remember my total debits came to like $3 million, and my total credits were like $200,000. It was not even close. And of course, I naturally started to panic, looking for what's going on. Spent hours and hours, couldn't figure out what's going on. Fortunately, a couple days later, the outside accountant was just coming in to see how things were going, checking my work. And it didn't take him long to figure out what was going wrong. I'm sure in the back of his mind, he's thinking, you're teaching accounting and you don't know how to do this. But it is what it is, I guess. The first time you do things, it's not always easy. He showed me where my mistakes were. And hopefully, like all of you, you learn from your mistakes. And once you start doing this enough, the beauty of accounting, you do it enough, you practice enough, to me, it becomes pretty straightforward. And you become much more comfortable with. So to me, it's not something you learn by just simply looking at these slides. You've got to do the homework. You've got to do all the practice exercises. And if you don't get it right the first time, don't panic. Everybody makes mistakes the first time through this. It's a brand new language that you've got to learn, but just stick to it, do the work. And I think at some point, obviously, I think it becomes very enjoyable. All right. So the beauty again here at the end here, once you got the trial balance and everything looks good, it's going to be very useful for helping us prepare the financial statements. Okay. So at this point, we can prepare a balance sheet. Very simple balance sheet. Again, recall the heading of a balance sheet, what's up here, the name of the company, and some sort of timestamp. With a balance sheet, the timestamp is always as of a particular date. So this is as of a certain date. So we're going to put our balance sheet in this particular format, sort of a side-by-side format. On the left side, sort of just reinforce our accounting equation. On the left side of the balance sheet, the assets, the name of the account, and the dollar amount. Where are we getting these from? Again, these are all coming from our trial balance. The beauty of the trial balance, or again, if you want to think it's coming from these T accounts. Okay, so you can find the numbers a couple places. So there's your asset side. We add them all up and give our total assets. The right-hand side, liabilities and equity, we list the liabilities. We only have one, accounts payable. Show the grand total for that. Shareholders' equity, we only have one. There's the grand total of that. Then we add it together, and there's our total liabilities and equity. And if everything works out, total assets equals total liabilities and shareholders' equity. All right? So now let's do some evaluation that we can have answer these questions as a result of what we've done. The first question, what is the book value of the firm? Okay. Again, two ways to think about the book value of the firm. Okay. One way we can think about it is that book value is equal to your assets minus your liabilities, minus your debt. Okay. So your assets are $220,000. Your liabilities up here, your accounts payable are $20,000. And you have $200,000 in book value. Okay. The other way to look at book value is go right to your shareholders' equity. We see that total shareholders' equity is $200,000. All right. So there's two ways to get that number. Right. Now, one of the things we can calculate is something known as the book value per share of common stock. If you go all the way back to the first transaction, when this company was started, in exchange for the cash that was given to the business, they issued 10,000 shares of common stock. So to calculate the book value, we simply take the common stock, divide by the number of shares, and we calculate that the book value per share is $20 per share. Okay. We may want to then compare that to the market value per share, but that's simply an accounting number from our accounting records, the book value per share. Then a key question, we'll keep asking this question throughout the semester. Where did this $220,000 come from? What was the source of those assets? And it had to come from somewhere on the right side of the accounting equation, from liabilities and equity. So three basic sources for where firms got their assets. One is, did they borrow? Did it come from the liabilities? One is, could it come from issuing equity? Or could it be from the other part of shareholders' equity is the retained earnings, what we call from profitable operations. Okay, so we look up here, where did it come from? Well, they borrowed, right? They have accounts payable, $20,000, right? Borrow by, again, allowing the vendors to give them the cards in exchange for that IOU. And then from issuing shares of stock, another $200,000. And at this point, retained earnings, there's nothing in there. Okay. So there is the source of their assets. $20,000 from borrowing, $200,000 from issuing stock, and nothing from retained earnings. It will always be those three sources of assets that you need to understand. Borrowing, issuing shares, retained earnings. Always the same one. The next question is, what are they going to do with those assets? Well, again, now they're going to start conducting business. They're going to use those assets to hopefully generate revenue. They're going to try and sell those cars, sell that inventory, right? They're going to have employees they're going to start paying wages to help them conduct business. So that's going to lead us into the next part. But for now, that is going to be the end of this